In a world overflowing with information and unpredictability, one of the most underappreciated competitive edges in investing is the ability to change your mind. The best investors do not anchor themselves to dogma or fixed narratives. Instead, they are guided by a disciplined flexibility. They treat beliefs as probabilistic bets to be tested, updated, or discarded. In other words, great investors are Bayesian. This doesn't just mean they understand probability theory. It means they internalize the deeper truth that mental models must evolve with the world around them. Their minds are not museums for cherished convictions, they are laboratories. This video explores how Bayesian thinking underpins superior investment performance, the psychology that resists it, and what it means to become an investor who adapts without losing conviction. The human mind is not built for Bayesian updating. It is built for consistency, comfort, and identity reinforcement. Our evolutionary wiring rewards stability. Holding on to familiar worldviews and filtering out dissonant data preserves social cohesion and reduces cognitive load. Flip-flopping is frowned upon, especially in public life. A politician who changes their stance is derided as unreliable. An analyst who adjusts their outlook too often may be seen as uncertain. These pressures intensify with age and experience. The more someone has invested in a belief, emotionally, reputationally, financially, the harder it becomes to let go. This is the root of confirmation bias, the impulse to seek out information that supports our pre-existing views, and to dismiss or reinterpret contradictory evidence. This is not just an intellectual failing, it is a biological one. Neuroimaging studies show that disconfirming information activates the amygdala, the brain's fear center, while confirming evidence lights up reward circuits. We are quite literally wired to feel good about being right, and to feel threatened by being wrong. Jonathan Barron, a psychologist at the University of Pennsylvania, introduced the concept of actively open-minded thinking, a cognitive style marked by the intentional search for evidence that contradicts one's beliefs. This is not passive openness. It is active, deliberate, and difficult. In forecasting competitions like the Good Judgment Project, participants who exhibited this trait consistently outperformed others. They didn't just seek confirmation, they hunted for disconfirmation. They weren't interested in being right. They were interested in getting it right. For investors, this translates to a kind of mental due diligence. It means welcoming red team critiques of your investment thesis. It means weighting skeptical analyst reports more heavily than glowing ones. It means constantly asking, what would have to be true for me to be wrong? At its core, Bayesian reasoning is a way to update your beliefs in light of new evidence. You begin with a prior, your initial degree of belief in a hypothesis. As fresh data emerges, you use Bayes' theorem to revise that belief up or down. It's like managing a living thesis, constantly rewritten by the world. Here's the intuition. Suppose you believe there's a 60% chance that a company's earnings will beat expectations. That's your prior. Then a new supply chain report surfaces, showing unexpected delays. A Bayesian approach doesn't flip your belief to 0 or cling to 60%. It revises the estimate, perhaps to 45%, depending on how relevant and trustworthy the new data is. The process is elegant but hard. It requires resisting the temptation to overweight vivid stories or underweight ambiguous data. It demands numerical humility, the ability to hold tentative views that can flex as reality intrudes. We've identified 2 scenarios where a Bayesian approach would have delivered well. In early 2023, NVIDIA was already up significantly on AI excitement. Many skeptics argued the move was overdone. But as quarter after quarter of earnings smashed expectations, and as capital expenditures across hyperscalers surged, Bayesian investors updated their priors. The AI hype started to look less like hype and more like a secular transformation. Those who rigidly held on to bearish priors, anchored in semiconductor cyclicality or crypto boom-bust baggage, missed a generational re-rating. Meanwhile, Bayesian thinkers recalibrated their thesis as real-time evidence confirmed product-market fit, supply chain resilience, and pricing power. For much of 2022, inflation fears dominated investor psychology. The dominant narrative was higher for longer. But by Q4, several disinflationary signals began to appear. Commodity prices rolled over, wage growth cooled, and shelter inflation began to decelerate. Many investors clung to their inflation hawk views. But Bayesian allocators started to nudge their portfolio positioning, increasing duration, trimming commodity exposure, and rebalancing toward growth. They weren't reacting to a headline. They were updating probabilities. When the Fed began signaling a pause in early 2023, the market had already begun to move. Those who updated early benefited from the shift, we quote V, identified two scenarios where a Bayesian approach would have delivered well. Being Bayesian doesn't just shape how you think, it changes what you do. It leads to incremental or sometimes dramatic portfolio shifts, reducing conviction in fading ideas, sizing up high probability opportunities, or tactically adjusting to new data. This mental flexibility can be unsettling to clients or committees who equate conviction with constancy. But conviction is not about never changing your mind. It's about having a deep process for how and when to change it. Bayesian investors can explain why their view changed, what data moved the needle, and how the new outlook fits into a broader framework. Skeptics argue that constantly changing your mind makes you look indecisive. But there's a profound difference between volatility of opinion and thoughtful updating. The former is noise, the latter is discipline. There are real risks, reacting to false positives, misjudging the quality of new data, or failing to properly weigh low-frequency but high-impact events. Bayesian thinking doesn't eliminate mistakes, but it reduces the odds of being consistently wrong. Being Bayesian isn't a static trait, it's a practice. Great investors build it into their culture through investment committees that challenge assumptions, red team exercises, and pre-mortem analyses. At the individual level, it requires habits like journaling your priors, noting what data would cause you to update, and explicitly quantifying your confidence levels. It also requires a social contract that changing your mind is a sign of strength, not weakness. The best investors don't treat beliefs as heirlooms. They treat them as working hypotheses, always subject to revision. This Bayesian posture is not about intellectual acrobatics or trend chasing. It's about getting closer to the truth, one piece of evidence at a time. Being Bayesian is not just a mindset, it is a method. It is a discipline. And most of all, it is an act of humility, an acknowledgement that the world is always changing, and that staying right means always being willing to be wrong first.